Peter Berezin is Chief Global Strategist, Director of Research at BCA. Peter, great to have you with us.
Good to be on.
What is remarkable about your call for 44.50 is that you entered the year with that call. So as all these Wall Street strategists have been scrambling to take down their forecasts lower in response to what has gone on, you were low to begin with. Does the pivot change? The pivot does not change anything. So what would have to change in order for you to reverse that call in any way, since this is all policy induced, right?
Well, I think we would need to see a much more dramatic walk back from these tariff announcements. I mean, right now, as of this moment, the effective U.S. tariff rate stands at around 20%, close to where it was during the 1930s. As a share of GDP, U.S. trades 3 times as much now as it did back then. So this is a really big hit to the U.S. Economy, and there's absolutely no guarantee that these negotiations are going to result in any major deals. So the tariff rates could rise, and that would put further pressure on the economy.
The 44.50 call, does that assume that a recession takes place?
Yes. I think the fundamentals of the economy weren't particularly strong going into this trade war. If you look at real personal consumption expenditures, they were actually down 0.5% in February relative to December. We're seeing increasing stresses in the consumer area, rising delinquency rates on credit cards, auto loans. There's 10 million Americans who are currently delinquent on their student loans. The pandemic savings that once exceeded $2 trillion are gone. And income growth has also slowed. In February, real wage and salary income was only up 1% over the prior year. And if you look at the CPI swap market, it's telling us that inflation is going to rise to 3.5%, more than a percentage point higher than where it is now. If that happens, we're looking at negative real income growth later this year. That's going to sink the consumer, and that'll sink the economy.
So, Peter, when you look back and you said there was the highest rates or the equivalent rates in tariffs back to 1930, we were just coming out of the Great Depression there. We're going into this with a much stronger economy. Does that change your mind? And I promise you this is not an I got you question. 2024, what was your target? I'm just trying to get a handle on if you're a little bit half empty glass or half full.
So I moved to a bearish view on stocks at the end of June of last year, prematurely in retrospect. But I was actually one of the few bullish strategists in 2022. And in 2023, we had kind of this call for an immaculate disinflation, arguing that inflation would fall with very little cost to grow. So I'm hardly a perma-bear. I don't think that the fundamentals of the economy were that strong going into this year. And the trade war now has pushed it over the edge.
Peter, you say that when you take a look at CPI swaps, which is something that you like to do apparently, it foreshadows a significant amount of tariff-induced inflation to come. If the Fed were to be preemptive and say, we're going to listen to this guy, Peter, at BCA, could we avert a recession, or can we avert those high levels of inflation? Or no, this is just, we're past that point right now?
I think we're past that point. I mean, the Fed controls short-term rates. They don't control long-term bond yields, which is what matters more, because those long-term bond yields set mortgage rates, and that is what helps to drive the economy. And those long-term bond yields are going up, and they're at very restrictive levels right now. And as a result, we're seeing pressure in all sorts of interest rate sensitive parts of the economy. I mean, if you look at the inventory of newly built unsold homes, it's now back to the highest level since 2009. So that's a problem for the economy, because housing is the only true leading part of the economy. And it's telling you that we're going into recession.